All right, welcome back to the channel. Today we got a trade idea. Now this is not financial advice. I'm not a financial advisor. I'm a dude talking into a microphone with plates behind him on the wall. So take what I say with a grain of salt. Be an adult, make your own decisions. So with that being said, let's get into it. So this is the TLT Bullish Bond Trade. That's a mouthful. I've talked about this in many videos, so if you're an OG, you've heard me talk about this. And I have started my position. I've traded this around, but this position that I'm building for the long, when I say long haul, this is a swing trade. Now I don't know if this will take 3 months, 3 years, I have no clue. So this trade requires a lot of patience, but I'm going to break it down. So we all know interest rates have skyrocketed, and they've skyrocketed from zero. So again, if we zoom out, we're looking at the 10-year yield. This is a weekly chart, so we're going all the way back here to the 70s. Interest rates have been on just a steady decline. Boom, 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 until they bottomed out at zero during the pandemic. And from the pandemic coming up, we've gone up 500%. Now that sounds like a lot, and you look at the chart and it's like, wow, we've barely gone anywhere. But in reality, we've moved a long way from where we were. So that's where we're at on yields. Now we hit 5% on the 10-year and we're starting to pull back down. So who knows where we go from here? The bet that I'm making, being bullish bonds, meaning I'm going to be buying the TLT, that bet is that rates have topped out and maybe they get back up to 5, but I don't see them going much higher than that. And I'm going to talk about many reasons why I think that's the case in just a moment. So this is the 10-year yield, which if you're going to get involved or understand this trade, you need to be watching this more than you watch the TLT, which is the actual vehicle that you would purchase. So here's the weekly chart of the TLT. It looks a lot different than the weekly chart of the yields. The yields are going down. The TLT has gone up, and it peaked when yields bottomed, and then it just plummeted down. So we are almost at all-time lows. 81 was the all-time low way back in 2003. And we're at 88 right now. So there's been a lot of damage here. If you've bought this at 166, you've been cut in half. So that sucks. We can see down here on the bottom, the volume's at all-time high. The buyers are stepping in. And I don't think that this is dumb money. I think people are saying that this is an asymmetrical bet. There's not a whole lot more downside, right? We're at all-time low. Rates have gone so far so fast. We're seeing inflation cool. We're seeing the economy still be strong, but the Fed has paused maybe 3 meetings in a row, 2 meetings in a row. So it looks like their work is done on their part. Now the question is the market done? Because we saw this huge run here recently of rates going up. This is without the Fed hiking. This is just bonds being issued into the market and there not being any buyers to buy it up. So this is very complicated. I don't want to get too deep into the weeds. Bonds are some tricky stuff because yields and price are inverse. So let's get into a few things here. So let me pull up not my email. That is not what anybody cares about. Let's find this guy. Come on. This guy. Boom. So the TLT trade. The bull case. Inflation has peaked. Economy is slowing. All the cash that's on the sidelines and in money market accounts will flow into the stock market and into bonds. Most likely bonds first. And then we're going to see the Fed being done with rate hikes. So that's the bull case. So if you want to buy the TLT, these are the things that you believe, okay, yes. The bear case, to stay away from TLT, is that the Fed is not done. And they're not done because inflation's going to come back. The economy's super hot. They can't slow the economy down, so they're going to have to do more interest rate hikes to slow things down. And that they're going to issue a ton of bonds, and there's not enough people to buy those bonds, so the yield goes up. So there's a reason why junk bonds issue a high yield, and that's because there's risk and there's less demand for those bonds. So if there's less demand, the yield has to go up to entice buyers to purchase those bonds. So that is why we've seen the yields go up recently, even though the Fed has not raised rates, is because it's a supply and demand. We're issuing all these bonds to service our spending, and there's not enough people to say, I'll buy those bonds, I'll buy those bonds. So that's, in a simple snapshot there, bull and bear case. So this chart here is showing that central banks around the world are starting to cut. So we're seeing stimulus starting to trickle into the market. Japan, China, who was it that cut their rates this week? One of the less well-functioning economies out there are really struggling, and that's also because the dollar's ripping. We're not going to get into all that. But you're seeing economies around the world starting to say, okay, Europe just entered a recession. We're starting to see things slow down. We're going to cut rates. So this right here is this is 2008 spike, when a lot of places had to cut rates. We had the COVID spike, all these people cutting rates. And now we could be at the beginning of another spike, or maybe this is just a little bump of global central banks cutting rates. So we're starting to see things soften up in other economies, and we're the best. We're the big dog, America, yay! So we'll be the last to crack, but we're starting to see other economies crack. Inflows. So we so far this year we've had $1 trillion flow into money market accounts. Now, money market accounts are not bonds, but they're paying a bond-like yield. So this is great. I have money in money market accounts in my Charles Schwab account. Money that I'm waiting to go buy Tesla at 150, but in the meantime I'm sitting getting 5%. That is great. Awesome. Love it. Everyone should take advantage of that. The problem here is when that 5% goes down to 4%. Or 3.5%, people are going to stick around and say, oh shoot, I need to go lock in this yield if I want to keep collecting this 5%. Let me go buy bonds, or let me go put this into a REIT, or put this into a stock, because the yield on this cash that I was getting is going down. So there's going to be a FOMO trade of people pulling money out of money market accounts and throwing it into other assets. And I think that's going to be bonds, because people have gotten used to this 5% coming in. And if you can go buy a 10-year bond or even a 2-year bond for 4.9%, people are going to lock that in, because I think we are reaching the ceiling. My opinion. People might go to 10-year bond and say, all right, give me 4.5 for 10 years. So you're going to see that cash that's on the sidelines start to go into other assets. And that is also a bullish case for the stock market, because there's going to be more money moving out of these money market accounts into other assets. And we're going to see that if rates keep just trickling down a little bit and not continuing to climb, which that is the case that is happening right now. Here's the bull case, right? So we look at the 10-year chart of the yield and we see, well, why can't we go back to 7? Why can't we go to 8? Why can't we go to 9? When I was in the 70s and I bought a house, rates were 22%. So why can't we go there? The reason is because we have so much damn debt. And all the debt that we issue out, we have to pay with the interest rate that is current, right? So if we issue bonds and we have to pay 5% and we issue trillions of dollars worth of bonds, that's a lot of debt that or a lot of interest that we have to pay. So it's not sustainable for us to keep printing all this money and having to spend on all these interest payments. So it's just no different than there's a reason why people are buying less cars and homes and solar, and that's because the interest expense has gone up so much, making that purchase more expensive. It's the same thing here for our government. Yes, it's different because a government can technically live forever and inflate the debt away, all that. A person can't. So because of the debts continuing to go up, right, our interest payments on that debt are continuing to go up. So it's not feasible for the 10-year rates to go to 7, 8, 9. Something's going to break before then. Remember in March when the banks were blowing up? What's going to happen if we have 7% rates? A lot of things are going to blow up. WeWork just filed for bankruptcy. That thing's a dumpster fire anyways. But how many quality companies are really going to struggle because they have all these other assets that are now 50 cents on the dollar, 20 cents on the dollar. So anyways, there's so much debt out there that there's a ceiling there as well. And right now the Fed is selling bonds, but eventually they'll say, okay, we're going to stop selling. And then eventually they'll say, okay, we're going to buy bonds because we need to get the rates down because otherwise things are breaking all over the place. So that is my opinion, the bull bear case. The way you can play this, you can buy TLT straight up. It's a stock. What's great about TLT is it's comprised of bonds, so it also pays a dividend. So it pays a 28-cent dividend, which is a 3.74% yield. That's not terrible. But I'm looking at this saying, okay, I don't see rates going from 5 to 0. I see rates going from 5 to 4. And then maybe from 4 to 3.5, and we stay there for a while. It would not be good for rates to go back to 0 because then you have FTX and you have Shiba Inu coin. You have all these boom bust cycles. I think everyone's fed up of a boom and a bust. Sustainable rates, not money printer go crazy, but just a more reasonable interest rate. So that's all I got for you. There's the TLT. You could play the levered play with TMF. I would recommend just sticking with the TLT because this may take a while to play out. This, like I said, 3 months, 3 years, we don't know. But eventually the Fed will say, okay, the economy's slowing. We're going to have to pull back and cut rates. But you can see in my bullish scenario, I don't even account for rates being cut. I'm accounting for money to go into bonds because there's all this cash on the sideline. There's all this debt being issued, and there hasn't been buyers because they're seeing the rates go up and up and up. Once people start to see that rate top out, then the FOMO trade comes in. People are going to say, let me lock in those rates because we haven't seen 5% in a long time. So this video went way longer than I wanted it to. If you're still here, I appreciate you. That's all I got for you today. Peace out.